You know, folks are always looking for that list, Charlie Munger. They say, just tell me what to grab. And I totally get it. Seriously, I do. It's in our nature. We want the quick fix, the easy road. But here's the deal. There isn't really an easy way out. Not at all. But if you're planning to purchase something and hold on to it for the long haul, and I mean for the long haul, like you're investing in a farm that you'll never sell, then there are definitely some companies I'd feel pretty good about. So let me share 5 of them with you. 5 companies that if I were to start fresh today, with just a little bit of cash, these are the ones I'd choose. And I'd just stick with them no matter what, through the ups and downs, the good and the bad. Because these aren't just shares, they're actual businesses. Legit businesses that create real products that everyday people use all the time. And they've been doing this for years, boosting their dividends annually, proving year in and year out that they have something truly exceptional, something that endures. All right, let me kick things off with the one I'm most familiar with, the Coca-Cola Company. So I picked up some Coca-Cola shares back in 1988. That's 37 years ago now, and I've never let go of a single share, not even one. People are always asking me, hey, Charlie Munger, don't you think Coke has hit its peak? Isn't the growth done? And maybe they have a point. Perhaps the era of massive growth is in the rearview mirror. But you know what? I really don't mind. Because Coca-Cola isn't just about selling a drink. They're offering joy in a bottle. They're providing a moment of refreshment, a little slice of happiness. And folks will always crave that. Here's how I see Coca-Cola. There are 8 billion people on this planet, and most of them, well, they consume several drinks each day. Coca-Cola boasts hundreds of brands, not just Coke, but also Sprite, Fanta, Danny, Minute Maid, and a whole bunch more. If they can manage to get each person to enjoy just one extra product from their lineup each week, just one more, the numbers are mind-blowing. That's the magic of scale. That's the magic of being present in every nation, every shop, and every eatery. They've been boosting their dividend for 62 consecutive years. 62 years, just think about that. Through wars, economic downturns, oil crises, and financial meltdowns, they kept increasing it. That really shows the strength of the business. Now, some folks might say, but Warren, soda sales are going down. People are more health conscious these days. And you know what? That's spot on. Absolutely right. But Coca-Cola has evolved beyond just soda. They've adapted. They've got water, juice, sports drinks, energy drinks, and even coffee. They go where the consumers lead. And here's the amazing part. They have the distribution network. They've built relationships with every retailer around the globe. So when they roll out a new product, it hits the shelves everywhere right away. That's their fortress. That's the edge they have that can't be easily copied. You can't just launch a drink company out of nowhere and expect to compete with that. So if I were picking stocks to hold on to forever, Coca-Cola would definitely make the cut. Not because they're going to see a 3-fold increase in the next 5 years, but because in 20 years, 30 years, or even 50 years, they'll still be in the beverage game, still raking in profits, still boosting that dividend, and that's more than enough for me. Now, the next company I'd invest in is Johnson & Johnson. J&J is really interesting because it's like 3 businesses rolled into one. They've got consumer health items like Band-Aids, Tylenol, and baby shampoo, stuff you grab at the pharmacy. Then there are their pharmaceuticals, which include prescription meds that tackle serious illnesses. And let's not forget their medical devices like surgical tools and implants, all the essentials that hospitals rely on. 3 distinct sectors, but all tied to healthcare, meeting that basic human need. The desire to be healthy, to feel good, and to live longer. And that demand, it's not going anywhere, not now, not ever. In fact, it's on the rise because the population is getting older. This isn't just happening in the United States, it's a global thing. Places like China, Japan, and Europe are all seeing it. Older folks require more health care, more medications, more procedures, and more products. And you know what? Johnson & Johnson is in a prime spot to take advantage of that trend. Sure, they've faced some bumps in the road over the years, lawsuits and issues with certain products. Every major company runs into problems now and then, but the core of their business? It's as solid as a rock. They've been increasing their dividend for 62 years straight. Just like Coca-Cola, 62 years of consistent growth. No matter what challenges came their way, they kept on paying and kept on raising. You see, there's something unique about healthcare companies. They have real pricing power. When you're unwell, when your kid is sick, when you need that medicine or surgery or any kind of medical attention, you don't go looking for the best deal. You pay what you need to pay. That's a really strong spot to be in as a business. And Charlie Munger, they've handled that position wisely. They haven't overcharged anyone. They've established a solid reputation. That's what makes their brand so powerful. When you see the J&J logo, it brings to mind quality, safety, and trust. And let me tell you, trust is everything in the healthcare game. So if I were to create a forever portfolio, J&J would definitely be on that list because folks will always need healthcare, and J&J will always step up to deliver it. It's as straightforward as that. Now, the third company, Procter & Gamble. They're about as exciting as watching paint dry, and I mean that in a good way. They produce soap, toothpaste, diapers, laundry detergent, shampoo, razors, paper towels, just the most ordinary, everyday items you can think of. And that's what makes them fantastic, because people need these products every single day. You brush your teeth each morning, you clean your clothes, you tidy up your place. You look after your little one if you have one. These aren't optional buys. You can't just decide to skip doing laundry for a month because the economy isn't great. You need laundry soap and you're going to grab Tide because it gets the job done. That's what you rely on. Check out P&G. They have this amazing lineup of brands. Tide, Pampers, Gillette, Crest, Downy, Bounty, Charmin. I could keep listing them. And these aren't just any brands. They're the top brands, either number 1 or number 2 in nearly every category they're in. That's impressive. That's really tough to pull off. And once you're the top brand, you can set higher prices. You've got pricing power because consumers would rather spend a bit more on Tide than gamble their clothes on some unknown, cheaper brand. Now, P&G has been increasing their dividend for 68 consecutive years. 68 years. That means they were building it up in the 1950s during the Cold War, through Vietnam, through the stagflation of the 70s, the crashes of 87, 2000, and 2008, through it all. And they kept pushing it because the business just keeps rolling. Folks keep brushing their teeth, keep washing their clothes, keep buying diapers. It's not thrilling, but it's reliable. And reliability is exactly what you want when you're investing for the long haul. You know, I often think about competitive edges, what I like to call moats. The things that shield a business from rivals. And P&G, they've got several moats. They've got strong branding. They've got scale in both manufacturing and distribution. They've built relationships with every retailer out there. They've got research and development capabilities that allow them to keep enhancing their products, staying ahead of private label challengers. And perhaps most crucially, they've got consumer habits. Folks grow up using Crest toothpaste and stick with it. Throughout their lives, they tend to choose the same brands their parents favored. That's pretty significant. It creates a barrier that only gets tougher over time. So yeah, Procter & Gamble. If I'm looking to invest in stocks for the long haul, they're definitely on my radar. Not because they're going to see a 20% growth every year, they won't. But because in 50 years, people will still be brushing their teeth, still doing laundry, and P&G will still be around, consistently increasing that dividend year after year after year. That's good enough for me. Now, the fourth company I'd throw into the mix is McDonald's. Some folks are taken aback when I bring up McDonald's. They think it's just a fast food joint, not fancy enough. But they're missing the bigger picture. McDonald's isn't just a restaurant chain. They're actually a real estate company that happens to sell burgers. Let me break it down. You see, McDonald's owns the land and buildings for most of their outlets. So what they do is lease those properties to franchise owners who manage the restaurants. This way, the intention architect receives guaranteed rent every month, plus a cut of the sales from the franchisees. They benefit when the restaurants thrive, but they don't shoulder all the operational risks. It's a fantastic business model. Seriously fantastic. And on top of that, they're in the food industry. And let's face it, people have to eat. Now, the intention architect isn't about fine dining. It's not the place you go for a special celebration, but it's super convenient. It's budget-friendly. It's reliable. You can walk into The Intention Architect in Tokyo, Paris, Dubai, or anywhere else, and you know exactly what to expect. That kind of consistency is really valuable. And they keep evolving. They introduced breakfast options. They brought in coffee to compete with Starbucks. They've got digital ordering and delivery now. They really pay attention to where consumers are headed. Plus, they've been increasing their dividend for 48 consecutive years. And here's something that catches my attention. The Intention Architect shines during the good times when folks have cash to spend on their gourmet burgers and fancy coffee beverages. But they also thrive during tough times when people are being cautious with their spending and need a budget-friendly meal. That's what you call a defensive strategy. That's exactly the type of business feature you want when you're planning for the long haul, because you can't predict what the economy will throw at you. But one thing's for sure, people are always going to eat, and many of them will opt for the Intention Architect. You see, the Intention Architect has created something that's really tough to duplicate. They have 40,000 spots across the globe. That's 40,000 pieces of valuable real estate, often in great locations. You can't just whip that up overnight. You can't simply say you're going to take on the Intention Architect and open 40,000 outlets. It took them 70 years to establish that presence, and each of those spots acts like a tiny little monopoly on convenience. That's their competitive edge. Plus, they've got the brand, those iconic golden arches that everyone recognizes. Kids grow up loving the Intention Architect. Then they end up taking their own kids there. That's what you call generational loyalty. That's something money can't buy. So if I'm putting together a portfolio for the long haul, the Intention Architect is definitely on the list. Not because I believe they're going to change the restaurant game, but because they don't have to. They've already created something that works, something that will keep on working, and that dividend, it just keeps climbing year after year. That's what I'm after. That's what you should be after too if you're thinking long term. Now, the fifth and last company is Walmart. Walmart is fascinating because they're not your usual dividend champion. They've only been increasing their dividend for 51 years, which is still quite impressive, don't get me wrong. But what's even more significant is that they're the biggest retailer in the world, and it's not even close. They pull in over $600 billion in revenue every year. $600 billion. That's an almost unfathomable amount of trade happening. That's more than the gross domestic product of most nations. And they've leveraged that scale to create advantages that no one else can replicate. You see, when you're that enormous, you can strike deals with suppliers in ways that smaller shops simply can't. You can ask for lower prices, you can request exclusive items, you can basically dictate the terms, and then you pass those savings on to your customers, which attracts even more customers, giving you even greater negotiating power with suppliers. It's like a flywheel, a positive feedback loop that just keeps on turning. Now, folks have been forecasting the downfall of Walmart for years. They're too massive, they can't change. Amazon is going to wipe them out. But you know what? They're still around, still expanding, still catering to millions of customers every single day. And they've adapted. They've ramped up their online shopping. They've got delivery options. They've got curbside pickup and grocery delivery. They're holding their own against Amazon and doing quite well, actually. You know, Walmart has something that Amazon will never possess. Physical locations, over 4,000 of them just in the United States. And those locations, they're not a burden. They're a valuable resource because folks still enjoy visiting stores. Sometimes they want to check out the product, feel it, and take it home right away instead of waiting for it to be delivered. Plus, Walmart can handle online orders from those stores, which means they can get your items to you quicker than almost anyone else. Same-day delivery, 2-hour pickups, all because they already have stock in a store close to you. That's a genuine competitive edge. And here's another thing about Walmart. They cater to everyone. Wealthy individuals, those with less middle-class folks. It doesn't matter. Everyone shops at Walmart because they all want to save some cash. And during tough financial times when money is tight, people flock to Walmart even more. So they're in a strong position. Just like McDonald's, they thrive in both good and bad times. That's precisely what you want in a stock that lasts forever. Now, Walmart's dividend yield isn't massive, probably around 1.5% or so, but they bump it up every year and they've got plenty of space to keep increasing it since they pull in so much cash. If you reinvest those dividends, if you just keep snagging more shares with the payouts they give you over time, over the years, you'll end up doing really well because Walmart isn't going anywhere. They're too large, too established, and too vital to the American economy. In 50 years, folks will still be shopping at Walmart. The stores might look a bit different. They could be more automated. Maybe you'll use your phone to check out, but they'll still be around, still catering to customers, still boosting that dividend. So those are my 5 picks: Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's, and Walmart. Now, you might notice they all share something in common. They're pretty dull. They're not tech companies. They're not going to skyrocket at 50% a year. They're simply reliable companies meeting fundamental human needs: food, drinks, healthcare, home essentials, shopping, and that's the key. If you're investing in stocks for the long haul, excitement isn't what you want. You want something you can count on. You want businesses that will still exist when you're elderly, when your children are elderly, and when your grandchildren are elderly. These companies have shown their strength time and again, surviving wars, economic downturns, tech advancements, and everything in between. They just keep going, keep earning money, and continuously increase those dividends. So let me tell you what I'd do with these 5 stocks. If I were starting fresh today with a small amount to invest, I'd buy equal shares of all 5. Just divide my money into 5 parts, and then I'd set up automatic dividend reinvestment. So every time they issued a dividend, it would automatically purchase more shares, and then I'd just forget about them. I wouldn't check the stock prices, wouldn't stress about what was happening in the market. I simply go about my daily routine, put in my hours at work, enjoy time with my family, and focus on what truly counts. Each quarter, I'd see more dividends rolling in, allowing me to purchase additional shares. Year after year, those dividends would gradually increase since all 5 of these companies boost their payouts annually. After a decade, I'd take a look and be amazed at how much it had expanded. After 2 decades, I'd be even more astonished. And after 3 decades, I'd find myself in a good financial position. Not necessarily wealthy, but definitely comfortable. Really comfortable. And here's the wonderful part. I wouldn't have had to lift a finger. I wouldn't need to be exceptionally clever or fortunate or try to time the market. All I had to do was be patient and let these companies operate as they do. Let Coca-Cola sell drinks. Let J&J take care of health. Let P&G handle laundry. Let McDonald's provide meals. Let Walmart cater to shoppers and gather my share of those earnings through dividends. That's all there is to it. That's the entire game plan. Now, folks might chime in, but Charlie Munger, what about tech? What's the deal with artificial intelligence and electric cars and all that cool stuff? Sure, those things are significant. They're likely going to transform the world in some way. But honestly, I don't grasp them well enough to put my money on them. I can't predict which companies are going to come out on top. What I do know is that folks will continue to drink cola, use adhesive bandages, wash their clothes, chow down on burgers, and shop for groceries. That's something I get, and I can trust in that, and that's what really counts. It's not about hunting for the flashiest stock, but rather about finding stocks you can believe in. Stocks that you can hold on to no matter what happens, whether it's market crashes, panic, bear markets, or recessions. Because if you can't stick with it during the rough patches, then you probably shouldn't have it when times are good either. You see, investing is straightforward, but it's not a walk in the park. The straightforward part is to identify solid businesses, buy them at fair prices, and hold on to them for the long haul. The tricky part is really about keeping them for the long haul, since the market is bound to take a nosedive at times. Your shares might drop, possibly a lot, and everyone around you will start freaking out, selling off, insisting that this time it's different, that the sky is falling and you're going to feel anxious, genuinely anxious. But that's when you have to remind yourself of what you actually possess. You don't just have stocks, you have your own businesses. And those businesses, they're still producing soda, Band-Aids, laundry detergent, burgers, and groceries. They're still catering to customers, still raking in profits, still dishing out dividends. Sure, the stock price might be low, but the business itself is doing just fine. And if the business is doing well, eventually the stock price will bounce back too. It always does. It always has, at least. Well, I think I've covered everything I wanted to share. 5 stocks to keep for the long term: Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's, Walmart. Not because they're flawless. Not because they won't face challenges, but because they bounce back. They've shown they can weather any storm. They meet fundamental human needs that aren't going anywhere. And they've been giving back to their shareholders with increasing dividends for many years. If you're young and just getting started, these are the types of stocks you should consider buying, holding onto, and forgetting about. Don't check on them every single day or stress over what some analyst on the Intention Architect says. Just hold on to them, reinvest those dividends, and practice patience, because that's the key. It's always been the key, and it always will be. You know, I'm Charlie Munger, and I've been in the investing game for over 75 years. The biggest lesson I've learned is that it's not about being the smartest. It's about being sensible and having patience. These 5 companies are wise investments for those who can stay the course. And if you can manage that, if you can grab them and keep them, just let time roll on, you'll do well, maybe even better than well. You'll create real wealth, the kind that sticks around. It's not about any fancy gimmick, not about trying to time the market or having some brilliant revelation. It's simply about owning solid businesses for an extended period. That's the whole deal. And these 5, they're solid businesses. Truly solid, so get them, hold on to them, and just forget about them. Allow time to handle the rest. That's my suggestion. Take it or leave it. But I truly believe that if you go with it, 30 years down the line, you'll be grateful you did. I know I would.